Hello, friends. Today we will discuss in the Weekend Investing Daily Bytes what is survivorship bias. We see this bias in our mind when we analyze the market and the history of the markets, but today we will see the real example of how survivorship bias actually came around as a concept. Uh, but first, a look at the markets. So Nifty has exactly come to that trend line resistance near 17,900, and we are still within the budget day candle, uh, fifth day inside it, and now we are at this crucial juncture where either we will break out of this trend line and this budget day candle uh, uh, range, or we will just sort of wiggle around here till we find more cues to go up. But it does seem like that the fear psychosis that was created around the markets, that one group of businesses will be able to take the entire market down because there will be contagion impact of a lot of debt and things of that nature, that seems to be very much in control. All banks have come out and said that they have no worry about that exposure. The stocks themselves have dramatically gone up, from the lows that they have made, and uh, we are essentially sitting quite pretty in terms of waiting for some more tailwind for this move to happen, and that can come around once the dollar index, which started to rise few days ago, if that settles down, and with the RBI hiking rates by quarter percent today and somewhat signaling that we are near the top end of the range. I think that all that bears good news for the quarters to come. So I'm personally quite hopeful that we will break through here, although I am wrong about 50% of times in terms of calling the market. But this is something that will come around, I think. Metals came back with a bang, plus 3.8% on that index after a dull week and a bad month of minus 10.8%. IT stocks rallying very hard, TCS winning some great orders, plus 1.5%. Pharma stocks, for a change, came back into the green. Commodities, energy stocks, infra stocks, there was a decent rally of sorts with real estate, FMCG, and banks kind of muted today. uh, the index broader indices were all within 0.77% to 0.89% range. Within the weekend investing performances, the top performance was from NNF 10, nearly 1%, along with MI 30, MI ATH2 at 0.67%, and some were lower here at MI 28.28%, MI 25 slightly negative, MI India top 10 slightly negative. There were several dividends that have been that companies have gone ex dividend, so there's an immediate impact of the index on that, because none of our returns that we show here include the dividends that we receive. So for large caps, you can safely assume about 1 to 1.5% of dividends add to those returns that we see as on model portfolios. Reliance was a big mover from the start of the day at plus 2%. Bajaj Finance moved up very nicely, plus 3%. Life insurance companies that were getting drubbed last week or so since the budget came back to life, with HDFC Life at plus 5%, SBI Life at plus 3%, Infosys, Wipro, TCS, as I mentioned, gone up. Cement stocks and steel stocks also very nicely up. Adani Enterprise is badgering the bears now after badgering the bulls. Adani Ports also plus 8.3%, and mixed bag for consumption stocks and general stocks there. Coal India, as I mentioned, went ex dividend here, and Aisha Motors is down 1.4%. That was a casualty. So, survivorship bias, very interesting story. Some of you may have heard it. There was a mathematician Mr. Wald. I'm forgetting the first name, Anthony Wald, I think. So what happened was that in World War II, US was sending out its fighter planes to fight the Nazis, and those these planes would come back with damaged wings, damaged tail area, damaged body area of the wings, and the military was the air force was wanting to find out how to best strengthen these areas, because these were getting hit the most. There were no hits on the engines, there was no hits on the cockpits. So Mr. Wald was invited. He was a mathematician. He was invited to study all the data and give his prognosis. And to their surprise, he told the forces that you need not strengthen the wings and the tail part of the aircrafts, because they are the ones which are sustaining the gunshots from the Nazis and still coming back. It is those planes which are getting hit in the engine or the cockpit which are not even coming back, and hence not even part of our data. So the entire problem was turned on its head. What the earlier thought process was how to strengthen these parts of the plane which are getting hit the most, became a completely reverse problem, where it was discovered that those planes that got hit in the cockpit and engines were not even coming back, hence not part of our statistic, and hence those are the areas which needed to be strengthened, so that if a rocket is hitting the engine part, maybe that can be saved. Maybe if it is hitting the cockpit, it can be saved. So this is a very common example how we can be misled by data. So like in the markets, when you meet somebody at a party, for instance, what will they tell you? They will tell you, this stock I made 10 bagger, and this one I made a 5 bagger, and I bought Eicher Motors at 200 and it became 5,000, and I bought Adani Enterprise at 200 and it became 4,000. So these are all survivorship bias stories. They are not telling you about the ones where they lost 80%, where they lost 60%, where they lost 70%, and the quantum of what was getting lost there. So the idea is that we need the complete picture to create our assessment, and usually what we get from the market is a survivorship bias data. So what we may consider to be extremely you can say good analysis based on certain data may actually be good analysis on bad data. So the data itself needs to be complete to make good analysis on, and we'll see more on this topic. So let's also look at success stories. So Bill Gates, Steve Jobs, Mark Zuckerberg, I mean, they dropped out of college and became extremely successful. Now, does it mean that every college student should think that they should drop out of college, and by that virtue itself they will become successful? So, or even in sports, Messi, Ronaldo, Neymar, highly paid football players, or in cricket, Kohli and other players. But the truth is, hundreds of thousands of youth try to become sportsmen, and 0.01% of them make it to any respectable level. Turning the same points towards the markets, we don't have data for Indian industry, but on S&P 500 in 1964, the average age or tenure, if you may say, the average age that a company lasted out of this S&P 500 sample was 33 years. So, an average company lasted for 33 years in 1964, and by 2016, it had shrunk to 24 years only. And by 2027, it is forecast it will shrink to 12 years only. So an average S&P 500 company will last for 12 years only as per the study, which used to be 33 years. So just see the kind of change that is coming in terms of how companies survive, how disruptive this world is becoming, and buy and hold forever is no longer a model that you can, bet upon. Yes, there will be some companies that will last much longer. That is why the average is 12 years. Some may die out in 3 years, some may die out in 20 years. But the whole idea is that the question about some company having some moat, having some edge, that seems to be just going away, because the disruption in the world is just at a pace where no company can just sit on its laurels and say that 5 years hence we will have this market share what we have today, and hence we don't really care. That era is gone. With the and you are seeing this in technology, you are seeing this in other aspects where capital suddenly for the last decade became so cheap that having capital was no longer a tool in your armory. So now looking at Nifty, and this is the same chart, average age of the company going lower and lower and lower, like this. So, and this is a phenomena which is very difficult to reverse. Now coming to Nifty, the Nifty composition of 50 stocks, 44% of Nifty companies have moved out since 2010. What was the Nifty composition in 2010? Those 50 companies, 22 companies have changed since then. So if you bought Nifty companies in 2010 and held those companies in the last 13 years, your performance likely would have been really poor versus what Nifty gave you, because Nifty was getting self corrected every 6 months. And every 6 months, the index committee will sit, it will take out the weakness from the index and bring in stronger stocks. So it's a self correcting mechanism, sort of, you can say, evolution theory in the market where survival of the fittest is happening. So, in my own words, I think Nifty is like a momentum index where you let the weakness go, you don't stick on to your losers, you bring in the strength from the stronger companies, and you stick with your winners. That's exactly what index does, but over a 6 month time frame. So the need is to stay a step ahead and not wait for the downfall of our companies to come, and we have to survive with the fittest of the companies and evolve with the new changes. If a new bunch of companies is coming and leading the market, we need to be with those companies, because what is a big name today, what is a big brand today, what is a big market share today may not last tomorrow. That is the sad reality of the world today. So a process driven strategy that will eliminate all such biases. The more we study about each company, the more is our bias to remain stuck to that company. And that creates all the difference in terms of decision making when we have to decide how to exit a company, how to enter a company, how to just be very mechanical and thorough in terms of our decision making. So as we say in a momentum investing framework, what to buy, when to buy, how much to buy, and when to sell, these four questions have to be crystal clear, and there should be no ambiguity about it based on survivorship bias or based on any other bias. So this was the topic for the day. Another insight that came around. Now the World Gold Council has uh, updated its 2022 net purchase figures for central bank buying, and it has come out with a statistic that central bank buying has in 2022 has been highest on record in the last 73 years ever, actually. And believe me, this is a astounding stat, if you ask me. And you must ask yourself, of the 2 to 3,000 tons that get mined every year, if central banks are taking away 1,200 tons out of that, I mean, something is happening in this world that we are not yet The narrative is not yet aware of it. I mean, since 2008, they have been accumulating, but now at a very increasing pace, including China, including Russia, including India, including Turkey, including Indonesia, including all other emerging markets. Everybody, central bank is buying gold. You need to ask why. If central banks are going to diversify their assets with gold, all the more reason that every other portfolio, every other allocation that you have should also be diversified with gold. And that is my belief. You may or may not believe me. That's your choice. So, this is something that I want you to think about, ponder about it, read about it. My purpose here in these daily bites to showcase certain concepts or certain asset allocation ideas is not nothing related with weekend investing products actually, but this is more of general content sharing. I learn when I study about this, and I want to share this with whoever would like to follow this, and that's the whole purpose of weekend investing daily bite. Of course, I want to remind the weekend investors there's a weekend investor loyalty discount available there. If you are renewing your annual subscription, you are eligible for an increasing loyalty discount as you grow seniority in your position in terms of weekend investing strategies. You can renew your current subscription and also use that same code to take on any other weekend investing strategy and create a bouquet of strategies if you like. So please be aware of this when you are doing this the renewal. If in case you miss it, we will not be able to help you post that event. So thank you so much for your time. Please do keep sharing these videos, and I will see you in another one. Bye.